All right. Can you hear me now? Let me know, guys. Okay, I don't know why our attendees on the Zoom call aren't letting me know. All right, so anyway, okay, now we got it. All right, so anyway, I apologize for that. I think I did not click the audio button. Just one of those prompts that come up when you start a Zoom call. So anyway, what I just said a minute ago was the idea that the due dates for the Chapter 17 homework quiz and bonus are going to be the 8th, and then the final exam is going to be due the 6th. And so just kind of look for those. Those are already available in Brightspace. In fact, I went ahead and made the exam itself won't pop up until the 29th. It just is programmed to show up. That's going to be Friday. So you've got a good week to work on that. And but that's really what's going on. So we're going to talk about the last segment here in this course, and that deals with standard costing. And so if anybody has any questions at all about Chapter 15, the budget process, which we just finished up yesterday, in terms of the homework quiz bonus, let me know. I'm more than glad to go back over that. One of the things I said, which apparently people didn't hear except people in this room, was the idea that these two final modules, as designated by chapters, sort of flow together, and that one sort of leads to the other. We talked about budgeting, and I've talked intermittently in this course about budgeting and why it's an important process and why it's critical to have a pretty good idea of where you're going, because if you don't know where you're going, how will you know if you got there? And also there are lots of elements of budgeting that we're not going to get into here, such as checking out one's peers in the industry and find out what they're doing, and whether or not that should factor into one's own budgeting. But one thing that we're going to talk about here, which relates definitely to managerial accounting, is this idea of standard costing. And then we're not going to get to this today, probably maybe on Wednesday, maybe next Monday, we'll talk about the balanced scorecard. The balanced scorecard is really this, it's just a tool that's highly customizable that allows businesses to assess performance of individual managers, okay? And it's, when I say highly customizable, there's no one size fits all with regard to that. But we'll talk about that, because remember, one of the things that I talked about early on in this course was the idea of managerial economics, managerial accounting. I'm saying managerial economics. Managerial accounting really relates to the idea of assessing the performance of managers. And to the extent that we can hold managers accountable for the things that they're responsible for, we can hold them accountable. Hence the word accountability, which relates very definitely to what we're doing here in accounting. All right, so any questions before we get started here? Let's start to roll with standard costing. So this is not a particularly long chapter. It's about medium sized, but it goes relatively quickly. I think some of the heavy lifting is going to be done today. And what I'm going to sort of give you a bit of advice on is to sort of highlight some of the tools that I think are going to be helpful to you as you sort of read the chapters, and also compare your notes, read the chapters, look at the PowerPoints, and also begin to work on the homework quiz and bonus. So we've really got 5 different objectives. We'll talk about standard costs, what they are. We'll talk about the variances, and we sort of talked a bit about this before, in the sense that when we got into the budgeting segment, we talked about this idea of variances and how there's no budget that's 100% perfect. You're going to have variances. It's just the way it is. I mean, anybody who thinks that you're going to land directly on the same numbers is really deluding themselves. And by the way, anybody who does do that, I think it's sort of a red flag. There's something that's no good, right? If somebody's hitting exactly the numbers, you got to wonder whether or not there's phony baloney accounting going on. And it does happen. It does happen. One of the last bosses I had in banking lost his job because he was caught sort of dumbing up numbers, which none of us knew, because he was reporting it to his bosses, not, he was our boss. But so I think the variances are going to happen. We're going to talk about favorable and unfavorable variances, both in terms of materials and also direct labor. And then we'll get to that today. Manufacturing overhead variances, we've talked a little bit about before, and there's not a whole lot we're going to cover on that. Then we'll talk about variance reports. And what's interesting about variance reports is these can be produced as frequently as is desired. It could be daily even. In fact, that sometimes is a reporting requirement. And there's a trend now in business the top managers want to see what's called a dashboard. That is just sort of something very visual, something that's all in one place. They don't have to do a lot of scrolling, a lot of reading, but they can see where things are in more or less real time. And that's really what's going on here with standardized costing, is that we can sort of look at more or less real time performance and make decisions about what to do about them. Okay. Then we'll get into balanced scorecards, which I talked about a second ago. And then we'll talk about this idea, finally, of controllable and non-controllable variances. Some variances we can do something about, others we really can't do much about. And that's kind of the way it is. Okay. All right. So let's get into it. Let's talk about what standard costs are. They're commonly used everywhere in business, and I think even in government, they're used in a lot of cases. I've never worked in government, but as I understand, standardized costing is common in a lot of different contexts, not just the for-profit world that we sort of study here. And then what they represent are predetermined unit costs, which companies use as some sort of performance metric. All right, let's talk a little bit about what's going on here. And it kind of goes to this idea of why we would create standard costs in the first place. So I want to emphasize something that I've talked about intermittently, and that is this distinction between financial accounting that all of you took at some point in Principles 1, which is external reporting, that is reporting to external users, but it's all based on historical data. All the information is historical. Even a balance sheet, which sort of tries to bring everything current and sort of takes a snapshot, is really sort of historical. If you have a December 31st year end, you're probably going to produce that balance sheet as of sometime in February, early March, something like that. So and the income statement itself runs all the way back from January 1st of the prior year to December 31st of that prior year. So it's all historical. So the thing is, okay, that's all well and good. And we know that business firms, particularly publicly traded firms like what we are representing here throughout college accounting courses, have an obligation to report information to the whole world, really. It's all public information. And they do it in a GAAP format in the United States in order to reflect what's been going on with the results of operations and where things stand right now. Okay, that's great. The problem is, we're talking about managing an organization. We really can't wait till the end of the year to decide, wow, we were really off in our estimate what it costs for us to make, whatever it was, bicycle seats in the Hayes Company example. We were really, really, really off. And at the end of the year, it's really too late. You can't intervene in order to change things. Now, maybe your idea of what it should cost you to make those goods was wrong in the first place. That will be revealed through the standard costing mechanism and the review of that data as it comes in on a fairly routine basis. It could be that you're completely off, and so you need to make adjustments. And that's something that should be taken into consideration. The budget itself, I mean, is something we sort of lay out as a game plan for the entire year, but sometimes it's not. It's more or less fixed in place, and you really can't change it. Standard costs allow us to say, okay, what are we going to do as of right now, January 31st? We're a month into the year, and we are wildly off. Let's make some changes. Let's make some adjustments. It could be there are some performance issues, and we'll talk about how those performance issues might be measured. And there are a number of different means by which that is done. So let's talk about some of the advantages of standard costs. This is probably maybe a little bit hard to see on the video, I don't know, but it's obviously in the text and whatnot. So, and it goes back to this idea of financial control. Remember, financial control is this concept in accounting. It's a management concept that goes back to what we talked about in Principles 1. I think it was chapter 5. That talks about one of the main features of what managers exist to do in the first place. That is planning, organizing, controlling, or planning, organizing, directing, and controlling, depending upon which framework you're looking at. But control is one of those key issues that take up a lot of managers' time. I always thought that as I moved up higher in management, I always thought control was sort of the thing that I was doing on a day-to-day basis. Putting out fires here, trying to deal with the problem over there, trying to deal with the cost issue, something like that. It was always something on a fairly routine basis. That's what managers are for, is to deal with things as they come up. They have the authority to deal with it, hopefully the knowledge and all that. So what are some of the advantages? It facilitates planning, and we're going to get to that a bit later. We'll talk about this idea of making employees more cost conscious. particularly as this information is used in a fairly timely feedback mechanism. It can make employees conscious as to what the cost of production are, and particularly those employees who are management. It can be also useful in setting selling prices, because think about this: if you know what it costs you to make a product, then you can set some sort of expected markup. Whether or not that markup sticks in the market, because obviously the demand side's got a role to play, whether or not they like that price or not, but it lets you determine, first of all, whether or not that product is even profitable. And there is an entire body of literature in business case studies talking about companies that are selling products that were never profitable to begin with. And they were flying off shelves. And all they were doing was sort of cutting in the overall contribution margin. Not a good scenario, okay? And we'll talk about this difference between standard and actual. That's really what we're going to focus on mostly today, is the standardized, which we say ahead of time, this is what we think it ought to cost us in terms of time, labor, materials, money, whatever. And the actual, which is the reported performance. This is where we do the comparison. And then we have this idea of what's called management by exception. I know this is a sort of a controversial term. A lot of people really hate that term, but it's the idea that managers sort of weigh in and intervene when something is out of whack with regard to the variance in actual versus standard. Okay, and I think sometimes it's construed as a negative, and I think probably I've had that view before, management by exception, where you sometimes don't hear from your supervisor unless something's going wrong, and that's just kind of the way things go sometimes. Everyone's busy, and you a lot of times hear when things are not happening correctly. Everyone wants pats on the back, but that's maybe not always the way things work, depending upon the culture in which one works. And so that's just kind of the way it is. And then also the idea of costing of inventories. And obviously inventory we've talked about quite a lot in this course, but even more in 2110 in Principles 1, because there are all kinds of issues and problems with inventory. And so as a result, anything we can do to better assess inventory cost is all to the good. Remember, we're trying to, as we produce products, we're absorbing them all into ultimately what's cost of goods sold. And the objective of the firm is to maximize profit, right? And so the better we are at estimating those costs, the better off everything is. Okay, so far this is not particularly detailed. We really haven't gotten into anything which really gets us there. And so let's sort of delve into it a little bit more here and talk about the difference between standardized values and budgeted values. So both standards and budgets, they're predetermined, and we talked about this before. Remember, the budgeting process, which we covered quite a lot in the chapter 15 segment, was about, at some point, most businesses will decide, okay, this is what we expect in terms of revenue, in terms of costs, and all these different categories. And it does include revenues. So budgets are a little bit more comprehensive than what these standards are. But they both contribute to control, this idea of financial control. But let's talk about the difference. Number one, a standard is a unit amount, both in unit and dollar terms, or quantity in dollar terms, where a budget is almost always expressed in a total dollar figure, okay? And so those are some differences. A couple other things that I might point out here that the text maybe sort of alluded to it, but maybe didn't get into it to the degree which I think is necessary, is the idea that budgets tend to be relatively fixed in nature. That is, when a company decides this is going to be our budget, again, the term budget is simply, we think of budget as being strictly dollars and cents and line items all the way down, but it's also it's timeframes, it's product emphasis, it's personnel costs. A lot of them are reflected in that. If you drill down below the numbers, you can kind of see that it's a plan, it's a roadmap, it's a strategy for, it's the manifestation of the strategy for where the organization is going in the coming year. And it's relatively fixed, okay? And I know that I am one who extols the value of what we call flexible budgeting, where budgeting should not be necessarily written in stone, brought down from Mount Sinai, boom, here they are, here are the commandments, and this is what you're supposed to do. But a lot of companies don't feel that way. A lot of companies think, look, we lock the budget in and we're there. And I can't recall if I talked about this in this section or not, because I've got a lot of classes But I was working for a company one time in which they took away a pretty major profit center from us, allocated to another part of the corporation, and yet they wouldn't adjust our budget for the year. And at the time, I thought, like a lot of us, that maybe our group manager was sort of, pulling our leg a little bit and saying, okay, if we make our budgeted numbers despite losing that profit center, we all look like heroes and whatnot. And I thought that was kind of the case until, and I was in banking at the time, early on in the year, we did a major credit card campaign because we had to make up that revenue. So I think he was really right. I think that they did not. They just sort of said this budget is locked in stone. Now, to me, to take away someone's major source of revenue and not to adjust one's budget is not a great way of management. But this is kind of the world in which we live. Sometimes managers, top managers, are not always flexible in those kind of things. And so the point I want to make is the budgets are a little bit more firm in place. Standard cost, however, whatever it is, standard quantity, standard price, we're going to get into all that, is a little bit more flexible. And the key thing about this is we can make adjustments as we go throughout the accounting period. That is, if we determine that things are changing, then we need to change also. This idea of not changing and simply saying this is where we're going to go, that's not good. Flexibility has got a lot of virtue, and so I think that's really what we need to hook onto. When we set standard costs, we're talking about the idea requiring input from people who have responsibilities for costs and quantities. And here, and one thing I want to say here, as I was thinking about this, looking this over yesterday, is that I was a little bit negative personally, and it's just my opinion. And I will tell you, when something is my opinion, it's my opinion. You don't have to write it in. You can, I guess. I'm going to stick with my opinion. But I think when it comes to budgeting, I think the idea that we involve everybody in the organization is a little bit of wishful thinking, mostly because a lot of people really don't have enough knowledge about how things fit into the bigger picture to really offer an opinion. I really don't think that's the case. Which is not to say that we as managers should not value people's opinions throughout the organization, but to expect them to get into what is a fairly intricate process of budgeting where things tie into other things and all kinds of considerations, I think is a little bit wishful thinking. I mean, it'd be nice. There are a lot of wishful thinking ideas that sort of permeate our lives, but just because we hope for things doesn't mean that they're true. However, I will say on standard costing, I think a lot of people who are very close to the work to be done actually have a better idea of what is possible. And that is, it's going to take us more labor to do what you're expecting us to do. So therefore, these labor quantities that you're saying are standard are not going to work. And I think we need to listen to those who are close, particularly those supervisors who are on a day-to-day basis there and say, it's not possible. You expect us to do it, it's not possible. Again, all goals need to be achievable with difficulty. And when management loses sight of that they've got to be achievable, the first part of that is achievable, then all we're asking people to do is to do the impossible, and it's not going to happen. And then if you're not achieving something, then nothing else really works, right? And what if this goes across the organization where no one is achieving their goals, and so the budget itself is just a meaningless process? We want it to be meaningful. Companies are striving to compete against other companies, which, by the way, are maybe more efficient at these planning processes. And then standard cost need to be current. I underline current here. So if things change, we can change. And when managers determine that something is happening differently, that we need to simply change our standards. Even in mid accounting period. And this is particularly true during inflationary times. And I bring this up because we're sort of in an inflationary period. I know the rate of inflation has come down a little bit, but it's not gone. And in certain goods, particularly labor, for instance, we need to really understand that wage costs can change, and we need to change the wage costs to accommodate the fact that there are higher wages going on, and also higher benefits costs and all that goes with wages. It isn't just wages; it's also materials as well. A lot of costs can change, and so if we don't change our standardized costing in order to reflect those, then we're really making a big mistake. It's a meaningless process unless we do that. And again, what are we trying to do here? We're trying to assess management performance and hold them to standards And the standards have got to be realistic, achievable with difficulty. But they've also got to be flexible in the sense that wages are going up dramatically, and we have to make some changes. I saw an article yesterday about McDonald's and a lot of their food prices to consumers have gone up like 40% in the last, I think, 3 years. And the explanation is it's because of their input costs, labor, materials have all gone up. That's pretty dramatic for a fairly short time period. That's well above the inflation rate throughout the entire economy. And so at some point, they've got to account for those higher costs. And they've got to the extent that they use standardized costing, and I have no idea if they do or not. A lot of these entities are run by franchisees. But you got to sort of keep up with this idea of what's going on and make adjustments likewise. If you don't, it's going to come back to bite you. Okay. All right. So let's talk about standard. Any questions before we go forward here a little bit? Right now, this is maybe a little bit vague and not particularly illuminating as to what's going on. We'll try to correct that here very shortly, but I'm just sort of trying to set the table here. When we talk about ideal standards versus normal standards, let's talk about this. And it goes back to this idea of achievability and achievable with difficulty. We have ideal standards, which is what we would consider to be price perfection. And that is the idea that if we are perfect, if everything happens perfectly, we will hit these ideal standards. And everything is going right. Nothing is going wrong. All the costs are under control. All the performance is happening as we expected. And so as a result, we have achieved these top tier performance. Okay. That's great. The problem is a lot of managers really strive for this and then push their people to achieve these, when in reality, this is difficult. And you may hit it 1 year, but then the next year things change. People leave, those personnel leave, materials costs change, competition forces some change in the way the product is produced or delivered, or maybe there's new regulation impinging on what we do. It's hard to be perfect year after year after year. Perfection is it's a fantasy, really. I mean, it just is. And so as a result, what we're really shooting for is normal standards. They represent efficiency and what can be done under what we expect to be operating conditions. Knowing, of course, that we're going to have some difficulties, and you've got to build in downtime. You've got to build in things going wrong. You've got to build in turnover, employee turnover. You've got to do a lot of things. And so, in other words, rigorous but attainable, and I said achievable with difficulty, it's the same thing. And they should align with the company's overall strategies, whatever those strategies are. So you can't set a standardized costing performance for one business unit that doesn't have any kind of connection at all with what the bigger organization is trying to do. Everyone is trying to sort of go in the same direction. And this is why it's difficult to involve a lot of people in the budgeting process, because a lot of people in the budgeting process really don't know what the bigger picture is. And frankly, I've worked in companies before where it's not very clear what the objectives are, because sometimes they are not made clear to everybody throughout the organization. And so as a result, the budgeting process is a little bit more difficult to involve everyone, but standardized metrics should be available to everybody, because everyone is ultimately accountable for doing something. I mean, it doesn't matter what you do within an organization, you are accountable if the company's got any kind of controls whatsoever. Whatever it is you do, you've got to be accountable in some fashion. Okay. All right. So most companies set standards, use them at I would say C, normal level, right? And so not in an ideal level. All right. So questions before we get into it. Let's jump into the main event here. Right now, all I've done is sort of give you a bit of a overall overview, I guess, an overview of what's going on. And I want to talk about specifically setting standards. Well, what standards are this idea of a realistic and rational assignment of value to the work that's to be done on an everyday basis. And we're going to talk about direct materials. We're going to talk about direct labor. We'll talk a bit about manufacturing overhead, and then we'll get to, hopefully before the end of class today, the comparison of actual versus these standardized performance metrics. And when we get to it, there's a particular graphic here I'm going to sort of tell you to really dog you or whatever you want to do, highlight, print off, but it's going to be really important to allow you to be able to compute what we call variances. And so let's look at direct materials first. Remember, we have three categories of product cost, right? In the manufacturing context, that's direct materials, direct labor, manufacturing overhead. So let's take the first of those three categories, it's a broad category of direct materials. And by the way, when we set standardized cost per unit, we're saying this is what we think, or it should be incurred throughout this next accounting period. The purchase price of whatever the unit of input is. I don't know what it is. It's sort of generic. It says it's $2.70 for that unit, whatever it is. Freight in. Remember these product costs become inventoriable costs. Remember that from earlier on. And freight in is an inventory cost. Freight out is not. Freight out is a period cost. Freight in is, and so we're going to say 20 cents per unit of the freight is absorbed on a per unit basis. Receiving and handling 10 cents, and so as a result, add these up, we get $3 per, I guess it's per pound. Okay, $3 per unit or per pound. These are input costs, right? This is what we expect to be performing. Now, where did this number come from? Did we just pull from the sky? Or is it part of the budgeting process? And this is important because remember, there was a connection between, even though I know we went through this exercise of differentiating budgeting from standard assignment, the standardization of costs and performance and quantities and all that really flow out of the budgeting process. And this is what we expect. This is our expectation as to what we expect in terms of the price per pound. This is just what we call the direct materials price, standardized price, based on what we rationally expect it to occur. Now, if things change, where freight goes up or the purchase price goes up or down, right, then we have to adjust our standard. And we can do that flexibly. Again, we're trying to assess management performance so that managers can be held accountable for the work that they do. Now, and so again, purchase prices can change. Also, one other thing too is this idea of discounts. And discounts sometimes come and go. And this is something that we talked a little bit about in Principles 1 is the idea. And even further back, if you took Business 1180, Business Math, where we actually got into quite a lot more discounts in that course than we did in Principles 1. And the idea that discounts can kind of come and go. Sometimes they're sporadic, they're periodic, it depends on your seller that you're buying from. Maybe they really want to encourage you to, buy more quantity or whatever. So discounts are a little bit tricky here, and it might be wise to not include discounts at all because they're really hard to control. Why are they hard to control? Because we don't control them. And discounts are offered by sellers. And so as a result, and these can change at any time. And whether they're discounts for early payment, what we call cash discounts or trade discounts that involve things like being a good customer or whatnot, or trying to encourage you to buy more of a quantity, a volume discount, it's kind of hard to know. So not only can the purchase price change, but so can the discounts. And so maybe, I'm just sort of throwing it out there. Accounting for discounts should be something that's taken with a grain of salt. Okay, so that is let me go back. That's the price standard. Okay, now this is going to be, I think, clearer as we get going a little bit further. Particularly, we start comparing these standards against the actual, and then we start to compute variances. And so, if you're kind of looking at this and saying, well, bear with me here, and it does become, I think, a little bit clearer. So this is what we call the direct materials price standard or cost standard, whichever you want to refer to it. Let's talk about quantity, okay? Setting standards is not just about, remember, when we talk about budgeting, budgets are usually based upon dollar figures, whereas these standards are based on units and dollars. And so in this case, we're saying the quantity of direct materials is the quantity that, again, should be used per unit of finished goods. And so per unit of output, whatever it is, we're saying it's 3.5, I guess, pounds, right? That's the denomination, 3.5. We have allowance for waste. This is important. Allowance for waste, allowance for spoilage. And this is the idea that some of these inputs are not going to be used. They're going to be scrap. We're going to have big pieces of plastic come across, and we're going to cut them into certain parameters. But the rest of it is we can't use. It's because we only use what we need. So some of it's going to be waste. Maybe we can recycle it. but it may not make sense to recycle it, maybe we just throw it away. And that's waste, and that's why we have big dumpsters around every manufacturing operation. Or spoilage, if it's an element that, or it's an input that goes bad, some of it's gonna spoil, some of it comes spoiled already. Spoilage is not uniform, and so sometimes we know that it's not always gonna be there. So what we're building in here is some slack into the process. I'm gonna talk a little bit more about slack a little bit later. I think it's an important consideration. Smart managers always build in some kind of slack. And that is the idea that some things are not always going to be as efficient. So you're not going to use every bit of materials to make the product. You're going to be molding it, refining it, doing something to it. Remember, this is a manufacturing context, so some of it's going to go away. So as a result, for every unit of output, we have 4 units of input. Okay. All right. So this is just direct materials. This is just the one category, product cost. And so we're saying that we have $3 per pound of inputs. Okay, and then it's going to take 4 pounds to make 1 unit of output. Okay, so kind of keep that in mind. I'll be referring and flipping back to this because I know sometimes these numbers are not always top of mind here, but I do want to, as I did in the budgeting process, sort of flip back and forth to various numbers, which is, by the way, a very common exercise everywhere in this sort of analysis. And so, all right, so yeah, this is where we get to the idea of standard cost, where we have the direct materials cost per unit. So remember, what is it? It's the standard materials price times the standard direct materials quantity. Well, that's pretty obvious, right? Remember it. So if it takes us, it costs us $3 per pound based upon our expectation of what the input price is going to be. The cost of inputs, $3 per pound, it's going to take us 4 pounds. Then it must mean then the price times the quantity is going to give us the amount of cost per whatever. And it says per gallon. I think the good in question here is some sort of high caffeine sort of thing, like you might buy at 7-Eleven. I think that's what the example is. I can't remember for sure, but that's the output, right? The output is a gallon of something. Okay. And that's just for the material standpoint. So what are we saying here? From a material standpoint, this does not include labor, this does not include overhead. It's saying it cost us $12 per gallon. By the way, this is something that managers in manufacturing are really usually very much up on. They kind of know what it costs to make a certain product based upon materials. They usually are very, very astute about that. And if things are changing, particularly as I mentioned, this idea of price, because of, particularly an inflationary period, that's going to move around a lot. But it may not be. This is probably going to be a little bit more stable, I think. Right? Quantities are really not going to change. I don't think, unless you've got lots of variance going on in terms of slack, that is wastage and whatnot, and maybe you can recycle some of that so you can mitigate that a little bit to the favorable. But for the most part, I think this is mostly stable. This is a little bit less stable. And by the way, I've kind of been doing this a while, and I know that for the most part, before we had this rise in inflation beginning around 2021, 2022, we really didn't think much about the idea of price variances moving around a lot. And that in a year, we could pretty much hang our hat on the idea that prices would be stable. We can't really make that assumption today. So this idea of $12 per gallon, we might agree on in October of 2024 for the next year, 2025. That may not look anything like reality come next July for whatever reason. So that's something to think about, okay? So this is really what's going on, is price times quantity. This is not all that different than what we've been talking about before. Remember, one thing that I've said a ton of times before is whenever you have a dollar figure multiplied or divided by a number, that's a number, you're going to get a dollar figure. That's the Trump value. So remember that always, always. This is going to be important too, particularly as we start to compare actual versus standard. We haven't gotten to the actual yet. The actual is simply as the data, as the cost information comes in, how we compare it against the standard, okay? Okay, the direct materials price standard should include all the following excepts: receiving, storing, handling, normal spoilage cost. We're going to say it's normal spoilage cost because and why is that not accounted for here? I've talked about this because it's in the quantity standard, not the price standard. It's got nothing to do with price. It's quantity standard. And by the way, I think one of the things that, and it's going to be a point of emphasis as I get going here is the idea that quantity standards tend to be a little bit more under the control of management, whereas price standards not so much. I mean, it's really, if you're a production manager, you really can't control that much the price of wages when it comes to labor. We'll get to labor in a minute, or the price of materials, but you can maybe have some control over how we handle things like spoilage. And it goes to the quantity standard. So the quantity standard may be a little bit more controllable from a day-to-day operational standpoint. Okay? All right, so that does direct materials. And if we're not done with direct materials at all, we're going to sort of work our way into grouping all together direct materials, direct labor, manufacturing overhead to get standard product cost. That is, what should it cost us to make a unit of output? In this case, it's a gallon of something that goes to 7-Eleven or Circle K. I think it's some sort of beverage, like you might see in a machine, right? Okay, let's talk about labor. Okay, so labor price standards are difficult to particularly remember. All the price standards are more complicated whenever there's a change in prices. We've seen a dramatic change in wages. Wages have been going up pretty dramatically, and that's good for workers who are getting wage increases. Yes, I know prices are going up throughout the economy, but wages have been doing pretty well. And it's a tight labor market. So these wages that we lock in on a per unit basis, per hour in this case, are sort of estimated ahead of time. And I think right now the issue of budgeting for labor has got to be very much subject to flexibility. I really do. I think it's very difficult to compute what wages are going to be down the road, particularly when the fact that a lot of companies are still struggling to find workers, and we see this all the time. Most companies are reporting they would like to hire people. That's a good problem to have. I know a lot of my early adult career, jobs were sort of hard to find because everyone had jobs and companies didn't want more. They wanted fewer, if anything, right? So this is a good situation, but this does present some issues in terms of arriving at standardization of cost per labor hour. Now, let's not worry about overhead yet and worry about how we're computing the driver for overhead. This is just the direct labor piece. We did direct materials, we're doing direct labor. We'll get to overhead in a minute. So we're going to say the wage rate is $12.50. Okay, it could be a weighted average based upon the entire workforce. That's probably realistic. Cost of living adjustment of 25 cents. That's probably pretty low in percentage terms in relation to that. And that is the idea that sometimes firms will build in wage increases just to maintain workers' purchasing power. It's not often the case that, at least in my experience, that companies will call it a cost of living adjustment. They might call it a merit increase. As you get an annual review, you've been a good worker, we're going to give you a 2%, 3% increase in pay, whatever. However, I will say this, that a lot of companies understand that they're not giving periodic wage increases and there's any inflation in the economy whatsoever, their workers are losing purchasing power. That might be okay for a year or two. The workers may not notice it that much, but over time, this sort of becomes a bigger problem as prices go this way and wages go that way. They don't go anything. Prices go up for goods and wages stay flat. Workers are losing purchasing power, and economists will say that workers usually will not sit still for that very long, and that they will demand a higher wage increase. And when we say demand a wage increase, it's usually, a lot of times people have this idea that they're going to form a union or they're going to walk out, or they're going to do something drastic. It's usually the fact they'll just simply move on and go somewhere else. It happens all the time. So companies have got to build something in, whether they call it a formal cost of living adjustment or not. And a lot of companies do not want to do it. They would rather tie it to performance. And I've seen that time and again. So that's the case. Also, payroll taxes, this is mostly FICA and also unemployment. This is a very low dollar figure per hour, I think. But we're talking about Social Security, Medicare, and unemployment taxes that are paid by employers, not by employees. The employees pay their own share of that. And unemployment taxes are both federal and state. We do have state unemployment tax that employers will pay in New Mexico. It's not particularly large, but that's part of the cost of the wage, right? The per unit wage cost. And then any kind of benefits, which we're saying $1.50 per hour. I don't know if that's a high number. It seems kind of low to me. But then again, let's not worry about the dollar figures. Let's worry about the identification what the items are. So wage increases, taxes, that's Social Security, Medicare, unemployment, health insurance, dental insurance, all that goes into it to arrive at standard labor cost per hour 15. Okay. And again, I know that let's not worry about the dollar figures. It's pretty low as a wage, particularly when you include things like payroll taxes and benefits. Payroll taxes themselves, Social Security, Medicare comes out to about 7.7% for the employer, and then unemployment insurance comes out to a little bit more than that. So it's a pretty big percentage, and employers have really got to pay. They have no choice. They've got to pay those taxes. Okay, so all right, so that's the labor price standard. We're saying it should cost us. Remember, the word "should" kind of is prominent here. It should cost us $15 per hour for this budgeting period for us to employ labor to do whatever it is that we're doing. Okay. All right. What about quantity standard? All right. So this is, again, all the quantity standards tend to be a little bit more arrived at by input from managers who are close to the work to be done, who understand what it's like to work with the machinery, the processes, and the workflow and all that, and the available labor force and any kind of indirect labor that might be involved and whatnot. So we're saying that it should take us to make a unit of output $1.5 hours, okay? And we're going to build in some rest periods and cleanup as people take breaks and lunch. They show up sick. There's also setup sometimes where the work is not being done because we're moving from one product to another. And by the way, this is something I really haven't mentioned, but all these assignments of standards in terms of prices and variances are, can be multiplied however many times by however many products are being made, however many work units. It can be done by shift. I mean, there's a lot of this that goes on. And when we talk about reporting, standard reporting, we'll get to the idea that a lot of this is fairly, voluminous amount of reporting. So in other words, what we're doing is we're building in slack, that the workers are going to be out for a time, they're going to take breaks, there are going to be slowdowns, there's going to be some downtime, things are going to happen where something breaks and whatnot. And I know that when I was a banker and had a lot of customers who were in manufacturing, sometimes an important piece would break and everything would shut down. And these aren't pieces that you can go to Home Depot or even Grainger to get. You've got to have them fabricated, and as a result, things would go down. So slack in the process is going to be built in. So we're saying it takes us 2 hours of direct labor to make 1 unit of output. Okay. All right. So that's the quantity standard for labor. And so when we talk about this, we're talking about the finished product is simply, it's the same rationale that we used before. And it was the idea that we have the price, what we call the labor rate, times the quantity or the direct labor hours. And I want to show you here, and I want to refer you to the text because I really like what the text has done here in sort of breaking this out a little bit. So, and I'll go back. I'll just go back a little bit here on the quantity standard. I'll come back to the price standard in a minute. But remember, we saw $3 per pound of direct materials. That's the price, and the direct materials quantity per unit. And we said $12 was the price times the quantity. Okay, that's the direct materials. But the same now goes for labor. And let's talk about these labor costs here, where again we took the same information. We said it's $15 per hour to make that's the labor per hour, just that was we're employing. And then how much of this labor is going to be employed to make output? We're saying it's going to be 2 hours of labor. And so for every unit of output, which is a gallon of whatever this is, it's $15 per hour times the 2 units, and we get $30 per gallon. Okay, that's the labor portion of the input cost that we absorb into the cost of the good itself, right? Now, this is not cost of goods sold. Remember, I keep emphasizing this because I really think it's important that when we talk about this project, this whole process, it's really an outflow of the budgeting process, and it's forward-looking. Cost of goods sold, everything's already done. The cost of goods sold, the action is already stopped. Now we're going back and we're computing the information We're reporting in the format that users can expect to look at. But here we've got some substantial flexibility as to what we think is going to be actual production time. Maybe if we get more efficient, we can reduce this and we can become more efficient for whatever reason, right? There is some intervention that's possible here. And as a result, we may be able to do something about these particular efficiencies. And efficiency is really sort of the name of the game when it comes to what we're trying to do here. Again, this is not historical reporting. This is a forward-looking sort of mechanism, okay? All right, so any questions about that? So we got materials variance, or I'm sorry, we have standardized materials cost. That's the price and the quantity standards that are set. We have labor standards, labor quantity, labor cost, and labor quantity. And so as a result, we end up with a standard labor cost. That's just the labor portion that adds on to the direct materials portion in order to get what we think is going to be the standard product cost. And then we have one final category. We talked about direct materials. We talked about direct labor. Let's talk about overhead. And this is nothing new because we've already gotten to this before. But I know the text kind of maybe presents it like, okay, we're going to talk about something called standard overhead rate. We've already talked about it because it's in Appendix F. Not all courses probably teach Appendix F or any of the appendices, but we've already gotten to it and we've already talked about it. And we talked about it in the context of activity-based costing. It is simply a way that we have a way of assigning overhead cost to unit cost. Given the difficulties that that arise with overhead generally, it's an indirect cost, doesn't necessarily suggest that it shouldn't be any particular amount per unit. We have to have some measure to set it to, okay? The overhead rates, again, we've talked about this before, taking the total budgeted overhead cost, when it comes out of the planning process, this is what we expect. A lot of that is based upon historical information, with maybe a little bit of a tweak for what we think is going to change during the coming year. And it's going to be based on oftentimes historical experience and some sort of driver, okay, that we call an activity driver. And it could be labor hours, which means that we're using more of a traditional method. Remember, the traditional method, there's nothing wrong with it, particularly in production systems in which labor is the dominant input. And I'm thinking service industries sort of come to mind here. Or machine hours, where use of capital goods like machinery and equipment is dominant. You could use that as a driver, in which case you're looking more at ABC costing, which is an alternative means of assigning overhead cost of product. But we've already kind of talked about this before. So when we talk about overhead rates, all we're really talking about here, one thing we will do a little bit different. When we first started talking about activity-based costing, we didn't get into the split between variable and fixed. We only really got into this idea of variable and fixed divisions of cost behavior. These are not product costs. These are they go into product costs, but it's cost behavior we're interested in. Variable and fixed. Again, variable costs fluctuate with the level of activity, and so if the activity goes up, the variable cost goes up, and the same goes on the downside. Whereas fixed in the short run is fixed. So in this case, Zonic, which is our company, they use standard direct labor hours. So in other words, they're using some sort of traditional method. Okay, that's fine. As the activity index, in other words, the pool of overhead costs is dumped into a pool that's all assigned. It's all related then to labor hours. And we're going to take that, we're going to divide by labor hours in order to get the cost per unit. So in this case, we're going to do variable and fixed both. And the process is that we've assigned 132,000 in total overhead costs for this coming accounting period, of which 79.2 is variable, based upon our expected production level. Remember, variable costs flow in the same direction as the overall unit of activity, as overall activity, in the same direction. 79.2 to variable, 52.8 for production. The standard labor hours are going to be based upon 26,400 labor hours to make two direct, because it takes two labor hours to make a gallon, and I believe it was 13,200 gallons. I think I saw that somewhere here. Well, anyway, that's we will get to that, but so in other words, if you take this divided by this, first of all, the variable is 79.2 divided by 26.4. It's going to be the same standardized hours. Total units of output times the labor committed to each unit of output, 2 labor hours. You're going to get $3 of overhead per unit cost, 52.8 divided by 26.42. These are nice round numbers. 3 plus 2 is 5. So $5 is the overhead portion of unit cost that is out per unit of output. Okay. So these are the input costs to make a unit of output. And this is the overhead piece. And again, like a lot of internal budgeting, you don't have to break this into variable and fixed. You can do it however you want. And this is not public information. This is not, we don't have to conform to GAAP requirements. We can do pretty much what we want to do here in order to arrive at some sort of standard budget. And then once the standardized units are arrived at, things change. We can make some changes on our own. Because what we're trying to do is we definitely want the ability to do course corrections as we're going. We unlike the budget itself, which may or may not be flexible, these standardized amounts should be subject to some flexibility. Okay. All right. So the standard manufacturing overhead cost per unit is that overhead rate times the activity based upon the index standard. So in this case, what do we have here? All right. So and by the way, I think this is also, let me see if I can pull up the text, because I really think the text does a nice job here of sort of breaking this out. And in this case, we've got these overhead rates of $5, and we have the overhead of $10 per unit. So let's do this. This is illustration 17.7. It's on page 17.7, coincidentally. And so you've got direct materials, direct labor, manufacturing overhead should give us a unit cost, not the price that we sell to the customer, but the cost per unit of $52. Okay, that's what we think it should. The word should cost us to do the unit of output. Okay, now where do these numbers come from? Let's go back and let's see where on earth we got these numbers. Okay, so we went back just to review. We have $12 per gallon of materials cost per unit, right? So that's the first element there. And if we come down here, we had $12 as direct materials, okay, per unit. 4 pounds times 3 is 12, so that's pretty straightforward, right? So that's where we got the direct materials piece of it. When it comes to the direct materials piece of it, it was direct labor piece of it. Direct labor piece of it is $15 per hour. And remember that it cost us, it takes us 2 units of labor to make a unit of output. So 2 units times $15 is 30. And then the final bit was the $5 per unit of output that absorbs overhead cost, which is at $5, and it's 2 times 2, because it's 2 hours of labor to make a unit of output. Remember, labor is the driver here. So if it takes us 2 hours to make a unit of output, then it's 2 hours here as well, because overhead is going to be based upon direct labor hours. So 2 hours is going to be employed times $5, and so $10. And so if you add these up, we get $52 as a standard cost per unit. In other words, that's what we expect it's going to cost us to make this particular product. And whether it is or not is really part of the question here. That's subject to whether or not we perform as expected, if things don't change. And I think it's safe to say that we should be building in to our expectations that things will change. But you're going to have something to hang your hat on. You're going to have some sort of standards that you can assess management performance, particularly in a manufacturing context, and particularly with quantity standards, because not meeting quantity standards is usually some sort of sign of inefficiency or something going on that maybe we can reorganize the work to be done a little bit better. We may not have much control over the prices of these things at all, really. Sometimes the prices are really outside of the control of management. I think that smart managers will acknowledge that sometimes they really don't control price of anything, inputs or outputs, by the way. So you're left with being more efficient than your competitor, offering a product that people want to buy. And those are all part of the overall strategic plan of the company that allows you to meet the overall goal of maximizing profit. Okay, so remember this $52. This is the expected cost per unit. Again, it's forward-looking. It's not historical. We don't know yet. We'll find out later as we go. And by the way, the later may be, who knows how quickly this input is. It could be by shift. It could be by It could be by day, it could be by shift, it could be by week, it could be by month. Again, there's lots of flexibility in how management reporting is done, and managerial accounting's got lots of flexibility in that regard, okay? All right, let's do a example here before we move on to the second segment, and that is an example I'll do for you on the board. And that's, we've got Write-It Incorporated accumulated the following standard cost data concerning its product, whatever that is. Okay, direct materials, one and a half pounds of direct materials per unit of output at $4 a pound. So this is the quantity standard. Direct materials quantity standard, direct materials price standard. Labor, quarter of an hour, that's the direct labor quantity standard at $13 per hour. That's the direct labor price standard. Manufacturing overhead, remember, materials, labor, overhead, $15.60 per direct labor hour. And we're saying the labor hours then, it's a traditional costing method keying off of direct labor, and it's a quarter of an hour to make a unit of output. In other words, a labor hour, or what used to be called man hours, but we don't use that term anymore. It's labor hours to make the unit of output. So let's do this real quickly here. This is a fairly easy one, and you can kind of refer back to your text, but it's just a way of us arriving at standardized cost based upon these particular values that are given. And again, this is a product related budgeting process, which hopefully is more flexible than not. So what do we got here? So we've got, first of all, we have direct materials, direct labor, and manufacturing overhead. Okay, we've talked endlessly about these three categories, and yet we're talking about standards here. So the quantity standard for direct materials is 1.5 units of whatever it is, pounds or whatever, at a price of $4, and so that gives us $6 of input cost per unit of output. That's for the materials piece, okay? And this is a dollar figure. So again, it's a number divided by or multiplied by a number. I'm sorry, the number multiplied by a dollar figure, which is going to give us a dollar figure. So that's $6. Direct labor, it's a quarter of an hour to produce a unit of output at a price of labor of $13 per hour. So 0.25 times 13 is $3.25. It's a dollar figure. The overhead is given at the same quantity standard because we're keying off of labor hours, right? If it was something different, like it was machine hours or setups or inventory moves, it would be some different figure, right? And probably some different dollar figure as well. We're saying the same labor standard, quarter of an hour to make 1 unit of output, and the dollar figure we've assigned for overhead. So it's actually quite a lot of overhead per unit. That's not unusual. Gives us $3.90. That's a dollar figure. So we add these up here, $6, it's $9.25, and that gives us $13.15 per unit, okay? That is the standard cost per unit for whatever it is we're making here. It's not made clear as to what the product is, doesn't really matter. We're saying, okay, managers, as we go forward, it should cost us $13.15 to make this unit based upon all that we've studied in terms of quantity standards for materials and labor, price standards for materials and labor, the overhead costing scheme that we sort of arrive at based upon what we think is rational and assigning some driver to it. This is what we think it should cost us to make this unit, okay? All right, so that's the process of setting a standard cost, right? That's what standard costs are. They're not historical. They're sort of they're forward-looking. They're maybe theoretical is even the word I would sort of use here, and but they're based upon research and they're based upon study and analysis. They've got to be realistic. Particularly with quality standards, it's got to be realistic as what you can expect your system in order to produce. And by the way, and we've said this a lot of times in this course, but we have this orientation of manufacturing. The same can be done as well for standardized costing when it comes to service industries. I'm thinking healthcare in particular. And healthcare pricing and costing is a completely different world. But there are standards that sometimes can exist what people believe it should cost to do things. Okay. All right. So any questions? We've got about 8 minutes, 7, 8 minutes, something like that. And I wanted to kind of get just a little bit further into this, and I'm going to sort of get to this idea of comparing standardized values versus actual. And we're going to pick that up on Wednesday and talk a bit more about it. But I think it's kind of good to sort of be thinking about this, particularly if you haven't read this yet, and talk about what to do about these sort of things. So we're going to talk about variances, and this is important. Now, by the way, we're going to talk about materials variances here, and this is just the first of the variances. We're going to get to labor variances probably on Wednesday. We'll talk more about these. But let's talk about, before we even get into this, let's talk about this idea of variance. And I talked a bit about at the outset of the course today. Variances are going to happen. You're going to have some sort of miss where you're not going to hit this standardized figure exactly. If you do, it's a little bit suspicious, actually. There's going to be a variance. We hope that it's a positive variance, or what we call a favorable variance on all these values. You might remember the other day when we were finishing up chapter 15, I said that all kinds of internal managerial reports have column for actual on all these items, and the budgeted or standardized, whatever, and you get a variance column. And if it's good, it might be black ink. If it's bad, it might be red ink, that sort of thing. And then the bottom line is what the variance is. Hopefully, it's not something that's excessive. And what is excessive? Well, it depends upon what management's definition of excessive is. They're running their own company. It's up to them to determine what's excessive and what's allowable and what's acceptable. And sometimes it's outside of everyone's control, particularly if there are wild things going on with prices and things. And that sometimes happens, and it just is uncontrollable, and you got to kind of deal with it. So the first variance, this idea of all variance is simply a difference between the actual numbers that are recorded based upon actual facts that have already happened versus the standardized facts that were projected to happen. So the first we'll talk about is materials. And so variances are, again, as I mentioned, the difference between those. And where actual is less than standardized, we have the favorable variance. Always, always. Whether it's materials, whether it's labor, whether it's whatever the case might be. And when the actuals are greater than standard costs, it's an unfavorable variance. In other words, it's outside of budget. And a lot of times managers will not use the term it's a variance to standard. They'll say it's worse than budget or better than budget. Again, a lot of people sort of mix these terms up, budget and standardized values. And it's just kind of the way, it's kind of the parlance that goes on in business, but it's not an inappropriate idea. So being less than standard is favorable, above standard, it's unfavorable. And here's what the key process is okay, so management accounts will report this data, or even it'll come out automatically because a lot of systems are able to capture things like labor and price, labor and quantity standards and variance. Sometimes these reports will be generated, automatically. So the question is what the variance is, where it comes from, and more importantly, what to do about it. Okay, so we have to find out what's going on here. And this requires sometimes sort of a deep dive into the elements of performance to find out what exactly is going on. So it's not always easy, but it's part of the process. So variance and favorable factual costs are, and in this case, we're going to differentiate budget from standard, even though I just said that a lot of managers will refer to this as budgeted costs, where it's favorable, but it's less than standard cost. In other words, what we have set as a standard, again, the term standard being a performance standard, so it's less than standard cost, not budgeted. And again, I know that the terms are often used interchangeably, but standards are really those things that are predetermined with a little bit more flexibility than budgeted figures to allow us in order to go forward and to assess performance. Okay. All right. This will be, we're almost out of time here, so I think that this is kind of a good stopping point. So we're back to our company that makes Zonic Tonic in the month of June. So a limited amount of performance here. 1,000 gallons was the output level. Okay. Remember, the standard was $52. Remember that from a couple of slides ago? Well, we said, so we're doing 1,000 gallons. That's the output level. And it's at $52. Our standard cost should be $52,000. Okay. And this is simply now looking back over the month of June and saying, okay, well, how'd you do? Production manager for the month of June. So what happened was, this is what we got. We had direct materials at 13,020, direct labor 31,000, variable overhead, fixed overhead. We divided overhead into two pieces. 55,000. No, actual is greater than standard, so we have a variance. And is that favorable or unfavorable? unfavorable because the actual costs are greater than standard cost. Now, it's not a gigantic dollar figure, but again, what if you added some more zeros onto all these values that may not be as as piddling as what it looks like here. So this is a variance, and it's an unfavorable variance. It's not identified here as being unfavorable, but it's an unfavorable variance. And so when we compare the actual versus the standard, assuming that the standard is still an accurate and achievable with difficulty sort of performance metric, then we're saying, okay, you've got some sort of variance here, and what's it due to? And so what you have to do then is to go back and say, 4,000 gallons of output, how do we do on direct materials? How do we do on direct labor? How do we do on overhead? We got to find out what's going on if we really want to know what the cause of the variance is. If we don't care, then I guess the whole exercise is mostly irrelevant. But when we talk about variances, this will be the last thing. And I'll probably come back to this on Wednesday, just sort of a jumping off point for where we're going. We talk about variance, and we're talking about all categories of variance: materials, labor, and overhead. We're going to get a variance that's going to be some bottom line figure, all production in some sort of whatever the given time frame is, whatever the given defined production unit is. But it's all these together, and some can be some can be positive, some can be negative. You can have a negative materials variance, or an unfavorable materials variance, a favorable labor variance, an unfavorable overhead variance, or any combination of all these favorable overhead, favorable, unfavorable. And this is very often what you see in management reports. You have all these categories of line items: favorable, unfavorable, favorable, unfavorable, and then it's the bottom line that is important clearly, but it's also, it takes this is where financial analysis is necessary to find out what's going on, particularly if there are big variances in certain areas. What if we can fix those, particularly if they're unfavorable, and arrive at something that is more favorable? Because obviously favorable means we're better toward achieving our goal of maximizing profit. Okay. All right. Any questions for me before we're almost out? We're about out of time. I really wanted to get to the next piece of this, but I think I'm going to have to sort of wait. Let me just give you a bit of a peek here. I'm going to tell you right now, and we'll come back to this, but I would print this or reproduce this or take a picture on your phone, do something. This is going to be very, very useful particularly as we approach variances, overall variance of either materials or labor, either one. That's going to be an important piece of the puzzle. It's also in the text. It's illustration 1711. This really does lay out the game plan, and I'll talk about this. I don't have time today, but I'll come back to this on Wednesday, and we'll talk more about it, because then what we're going to do is we're going to get into some calculations of variances both in materials and labor. Okay? All right, so we'll do that. If you have any questions for me about anything, feel free to get with me. Otherwise, I'll see you all on Wednesday. I will be here Wednesday. That's the day before Thanksgiving, but I'll be here, and hopefully I'll see you as well. Okay, see you.